Ladies and gentlemen, good day and welcome to Cartrade Tech Limited Q4 and FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Sanghi, Chairman and Managing Director, Cartrade Tech Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, everybody, and thank you for joining this quarterly earnings call and also the year-end financials call as well. First of all, it gives me great pleasure to welcome all of you, and we have also uploaded a presentation, and I'll go straight to the presentation to give you some key highlights for the quarter and for the year. On slide 3, first gives a summary of some of the key metrics. It gives me great pleasure to tell you that we've achieved the highest ever revenue in the year, in the quarter, and also highest ever adjusted EBITDA in a quarter or in the year. That revenue has grown by 20% for the year. Adjusted EBITDA has grown by 28% during the year. We continue to be India's leading automotive platform. We're almost now 200 plus physical locations. In the last year, March 23, we auctioned 1.1 million vehicles. On a consumer platform, we received 34 million in the last quarter. We received 34 million unique customers every month. I think what again is remarkable is that 86% of these came organically, which shows why our margins have stayed strong. Revenue for the year was at 427.7 crores, which is, as I said, a growth of approximately 20%. And for the quarter was 116.6 crores. Which is also the highest in any quarter. Adjusted EBITDA was 124.9 crores for the year and 39.8 crores for the quarter, which also is the highest ever. Profit after tax is 40.4 crores. Do remember that this is also after deferred tax of approximately 11 crores in this PAT. And adjusted PAT, adjusted for ESOPs as well as deferred tax, is approximately 80 crores for the year. We continue to be a strong business with completely no loans or any kind of debt, with a strong cash balance, almost 1,100 crores in the company. If I go to the next slide, which is the consolidated financials for the year, which is slide 4, as you can see here, the revenue for the quarter is 116 crores. The revenue for the year, the net revenue for the year is 421. The net is netted for some of the transaction business and comes to a growth of approximately 20%. Expenses from last quarter to this quarter stayed stable. Adjusted EBITDA has gone up to 39.8 crores in the quarter compared to 36.6 crores in the previous quarter. And for the year is 124.9 crores versus 97 crores the previous year, which is a growth of approximately 28% during the year. I think the other thing is the adjusted EBITDA margin. As you can see, it is 34% for the quarter. If you remove other income, then the adjusted EBITDA margin comes to 20% during the year, and 20% during the quarter, and 17% for the year. The other key highlights in the consolidated accounts are, of course, the adjusted PAT and the PBT, which are below. The adjusted PAT for the quarter is 23 crores and 80 crores for the year, which is a growth of the adjusted PAT has grown by about 42%. And as you can see here, the profit after tax is actually turned profitable during the year. It's 17.49 for the quarter compared to a loss last year, and the loss last year due to an ESOP entry or an ESOP cost which was taken in our accounts last year. If you go to the standalone financials for the quarter, which is just the standalone accounts, which mainly includes the consumer business or consumer platforms, You can see that the quarters had a 58.7 crores in net revenue, which is a growth of 35%. The year revenues are 204.94 crores, which is a growth of 38% in a standalone. And as you can see, costs remaining stable in the quarter, and then therefore you've seen a big jump in our adjusted EBITDA for the quarter, almost 101% growth. And this is something we've been talking about in multiple calls, over the years, that increase in revenue results in a disproportionate increase in EBITDA. And as you can see, a 35% growth in revenue in the quarter has led to 101% growth in EBITDA during the quarter. And in the year, 38% growth in revenue has led to a 94% growth in profitability. The EBITDA margin is 41% with other income and 19% without other income, which has also grown in the year to 15% versus 5% in the previous year. So most of the numbers on the standalone accounts extremely healthy, and we feel pretty good about the business on the standalone consumer business for the last year. If you look at the next slide, which is the remarketing business, we've had headwinds here. In the quarter, there's been a slight degrowth, and for the year, we've had a slight growth of 6%. EBITDA has also been hit in the year, we're down 13%. And adjusted EBITDA margins are also hit from 24% to 18%. Even though Shriram Automall continues to have a adjusted EBITDA of 15 crores versus 12 crores the previous quarter. So there's this quarter has been slightly better than the previous quarter. There have been quite a few headwinds in this business, and we've talked about this in the last two quarters, where the headwinds are mostly on account of the supply coming from repossessed vehicles, which has seen a little bit of a downturn with markets being a little better. We've seen a good big growth in our retail business. In fact, I'll share some of these percentages a little later on supply coming from various sources. But we've still seen headwinds in the repossession side of this business and growth on the retail side of the business. So overall, we've seen headwinds in the entire consolidated Shriram Automall business, and we feel that hopefully in this year, at a later stage, it will correct itself. If you look at the next slide, which is the organic monthly unique visitors, it's about 34 million in quarter four versus 29.8 million in the previous year, same quarter. So we've seen a reasonable growth in our unique visitors per month. As again, I want to stress that this is 86% organic, which is one of the reasons why the consumer business has seen leverage in its adjusted EBITDA going up. The next slide is really our Google Trends and our popularity around brand affinity, which is really a reflection of our online search popularity. And you can see here the gaps continue to be there versus our competitors. Carval is indexed at 83 versus 21 being the next, and Bikewala is at 90 versus 45 being the next. So we've seen a strength on online search popularity continuing. The next slide is about auction listings and volumes. And here you can see for the quarter has been 286. For the year, it is 1.1 million. I think listings have been more or less flat, and so have the auction volumes, which is a reflection on SAMIL's financials, Shriram Automall's financials by itself. These are high-level metrics. There are some other ratios I'd like to talk through. One is our percentage of used car to new car revenue in the consumer group. This year, the used car revenue has gone to 16% of our total consumer group revenues, which was 9% last year. So it is 91% new cars last year, which has gone to 84%, 16% used cars this year versus 9% the previous year. I think the other thing we've seen here is the growth rates. The used car business has grown about 136%, whereas the new car business has grown about 26%, which really makes up the entire growth of the consumer business. If you look at the OEM dealer split in our consumer business, it was 65% OEM and 35% dealer. That's become 61% OEM and 39%. The dealer business has got better. And if you look at the Shriram Automall, some key metrics which we give out, the percentage of repo business has gone from 69% last year to 55%. So we've dropped in the repossession supply in terms of percentage of our total business. And our retail business has gone from 21% to 33%. So we've seen huge growth in the retail side. And of course, as I said, we've seen lots of constraints on the repossession business. This has gone from 69 to 55% of our business. So these are some high-level metrics of the company. I'm happy to, answer questions which you might have and clarifications you might need.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Siddhartha Bera from Nomura. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity.
Hi, Siddhartha.
Sir, just first a housekeeping question. This OE and dealer revenue mix or growth, can you share for this quarter how it has been for the standalone business?
You want the split?
Yes.
It is for the quarter, it's 62-38. I said for the year, it's 61-39, so it's not much difference. Anisha, is that correct?
Yes, Vinay. So for just in the quarter is about 62-38 too. So very similar.
Okay. And the new and used will be new car and used revenue mix?
For the quarter,
14% and 8%.
it's been similar, 16-84.
Yeah.
Okay. So quarter on quarter, not much change?
Not much change.
Not much change. Okay. And sir, second question on the growth side. I mean, we have shown a good growth momentum in the current quarter. So what is the outlook for the coming year? Given the trends or given the sort of traction you are seeing from the OE or the dealers, what is your expectation for some of these growth momentum? Is it, will it sustain or normalize, or how to look at the next 1 year?
We don't give any guidance, but we generally think that if you see the OEM, I mean the new car sales in India have grown about 28% this year. I think most predictions are around the fact that it'll grow at 8-10% in the coming year. We feel pretty good about the business environment in the last quarter. We're just hopeful the same business environment continues, for the next 3 months, 6 months, 1 year. So we feel pretty confident. I can't give a growth number, but we feel pretty confident. I just want to stress one more thing, that if you look at the 5-year CAGR of the company, growth rate, in the past 5 years, of course, it's an annual report, and it's at about 23% and 69% growth in EBITDA over a 5-year period CAGR. So, we've had a consistent growth and profitability growth track record over the last 5 years. We feel pretty good that this year should not be any different. I mean, the market looks fine at this point.
Okay. No, because, on the new car side, we expect growth to slow down meaningfully this year. It may not be more than 5-6% is our view. So, on that context, given that, generally, like you have said in the past, in case demand slows down, it leads to more incentives for the OEM to advertise more. So should we expect that for us, growth should continue to remain in healthy double digits, is what I was just trying to understand.
Yeah. What we said is that when demand not when demand slows down, but when supply is more than demand, it helps us, is what we said. Which means that there are shortages of vehicles. The supply of manufacturers more than demand, it's a more favorable than when vehicles are under shortages, because naturally manufacturers and dealers don't need to advertise. So, I think we're moving more to a market where demand exceeds supply. But we still want the new car industry to grow. I think it's a combination of all of that.
Okay, got it. And second, on the margin side, obviously we have continued to demonstrate good margin trends for the last 2 quarters. So is it something we can expect that with at least a double-digit growth, we should sort of continue to build on what we have reported in the last 9 months? Or
Absolutely. I think our cost structures and unit economic structures and the way the companies are built is that with revenue growth, you see a more disproportionate growth in EBITDA. And you've seen this demonstrated now across the whole year, 34% led to a 92% growth in profit. So I think that's quite clear that growth in revenue leads to a disproportionate growth in EBITDA. So that's not our basic business model, and cost build-up has not changed. And this is typical to businesses like ours, marketplaces business like ours, where costs don't increase with proportion to revenues. In fact, we have two principal costs, marketing and people. And if you see over 5 years, our marketing costs are flat over 5 years. And at 34 million customers a month, right? It's still flat over 5 years. So, we do feel good about the fact that with the revenue increasing, costs don't go up in proportion.
Yeah, because on a quarter-on-quarter basis, our marketing costs have gone up. So given that if you are expecting demand to slow down, so shall we expect current trends to sustain, or there can be upside risk to that extent to this sort of that?
I think we should assume the same cost structure as we have today.
Okay. And lastly, sir, on
there will be some escalation in costs. I think there will be some escalation in costs because as you know, 1st April, we all have an increment cycle. So you'll see some escalation in costs because of increments. But that adjusts itself through the year.
Okay. Sir, on the offshore side, we have not commented much this time, so just wanted your thoughts on what is happening there.
The auction side, actually, we've had a tough year, and I think the tough year is because...
Sorry to interrupt, sir. Offshore.
Oh, the offshore. Sorry. My mistake. I heard auction. On the offshore side, actually, this quarter and the last 3 months, I have slightly modified it. I think we've got offshore outlets and we've added another range, what we call signature outlets. And I did not stress, but we are close to about, I think, 90, Anisha, is that correct?
Yes.
Close to 90. Which, as I said, we've added a new dimension here because we want to scale up now. We're quite confident that we've tested the model. I think the whole offshore model is created so someone can book a car online and have the logistics of delivery, et cetera, get certified cars, et cetera. And a lot of that is now played out. As you know that, we try to build a very asset-light model and we continue that endeavor. And our objective is to grow these offshore and signature outlets over the next 2 to 3, 4 years now. It's, as I've also just highlighted, that our used car business has grown 136%. Part of it is offshore, part of it is, just a classified used car business growing itself. But we seem confident and bullish about it. It's a very, very small still part of our entire business. Used car itself is only, as I said, 16%. So it's a small part of the consumer group, but, we feel confident about it for the future.
Got it, sir. Thanks a lot. I'll come back.
Thank you. Thanks.
Thank you. We have our next question from the line of Ankit Kanodia from Smart Sync Services. Participants are requested to kindly restrict their questions to 2 at a time so that the management is able to answer queries from all participants. Mr. Kanodia, please go ahead.
Thank you for taking my question. And first of all, congratulations on good set of numbers, especially in the consumer set of business. So my first question is related to the main pain point which I see in your presentation and which you alluded to in your opening commentary also, which is the auction listing volume and particularly the repossessed vehicle. Would you throw some more light there as to what is happening here and what can change for the better in the coming time?
I think what we've seen is volume on the repossession side, slightly degrow. And I think that is, we're hearing multiple reasons. One is, of course, the fact that, the economy has done better and clearly people are able to pay loans. So that is one factor why repossession itself has gone down. I think the second factor which is given is, and when we talk to our customers, is that resale value of used cars or used vehicles is up, and therefore people will not surrender vehicles but pay off the loans. So I think these are two big factors we've seen. We're not sure, whether it's cyclical and whether this will, but these are cycles which the repossession industry has gone through several times in the past as well. So, these are cycles and a cyclical part of the business. I think where we've made effort to counter this drop, and we were 69% repossession volume, so that's where it's hurt us. I think where we feel good about the business is we've been able to substitute a large part of that with growing fragmented supply, retail supply, which basically makes us a healthier business for the future. Because when the repossession volumes do come back, our retail business would also, be of certain strength, and therefore it will enable the company to have a much, much stronger future. So that's the good part. But repossession has been a very tough, 6 to 8 months.
Thank you. That really helped. My second question is, I think we have been discussing this for last 2 quarters now. So we are around a 2,000 crore market cap company now and 1,100 crore of cash. At the board level, are we having any discussion on buyback maybe even a small buyback of 100 crore or 150 crore can do our good confidence booster for the investing community. Do we have any discussion on the board level or at least?
Yes, we do discuss this from time to time. I think we also discuss the regulation around what quantum we are allowed to buy back and not buy back. And it's still under consideration of the board. I don't think we've come to any conclusion as yet what to do or what not to do.
Sure. Thank you so much and all the best.
Thank you.
I'll come back in the queue if I have more questions.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Raj from Arjav Partners. Please go ahead.
Yeah. Am I audible?
Yes.
So the first thing I want to say is for 12 p.m. call, you are uploading everything at 11:55 a.m. So I think it is a bit unfair for all the investors, I guess, sir, you know?
Yes, sir. I'd like to apologize for that. Sorry for that.
Yeah.
We'll make sure that next time we do that earlier.
Yeah, please. Thanks. Yeah. Other thing I wanted to ask is, what is there in your other income?
Anisha, you want to explain?
Sure. So our other income includes treasury income, which is because we have large funds, which is about 1,100 crores. These are parked with highly conservative mutual funds and overnight funds, which yield a return, which is classified under the other income.
All right. And how much of interest is being earned on these funds?
Ballpark about 6%.
How much?
Ballpark about 6%.
6% interest you earn. All right. And also regarding, I wanted to ask about adjusted PAT. So what adjustments have you done in it?
This is adjusted for deferred tax, which is about 11 crores, right, Anisha? And ESOPs of cashless ESOP is about 27 crores. Is that correct?
Yes.
27 crores ESOPs. Okay.
Yeah. And there's also PAT below, which is approximately about 40 crores. The adjusted is about 79.
Yeah.
All right. And also for FY24, can you give a rough outlook on the operations of the company? Like, how do you see going ahead?
We don't give a guidance, but what I can say is that we feel pretty good about the state of the business and the state of the market on the consumer group, which is the new car and the used car consumer platforms. In the near future, it seems that the repossession industry will still continue to go through what has gone through in the last 6 to 8 months. But there again, we're making lots of efforts to get supply from other sources so we can continue to grow at Shriram Auto Mall as well. We feel pretty confident about the business and has many reasons why. I think one is really the traffic of consumers on our platform and really the leadership we have on our search popularity and marketing costs related to that. On the consumer side of the business, the traction of used cars growing, which we see a very strong positive for our business. And really on the Shriram Auto Mall, as I said, we've established a new vertical of fragmented retail supply. So we feel quite confident about the business. There are some headwinds on the repossession side which continue to be there, but on the whole, we seem very, very reasonably confident about the business.
Thank you. We request you to come back in the queue for follow-up questions. We have a next question from the line of Sachin Dixit from JM Financial. Please go ahead.
Hi, Vinay. Congratulations on a great set of results. So I wanted to talk regarding the OEM's advertising spend, right? So I believe since COVID, the demand-supply mismatch has resulted in ad spend going down as percentage of revenue for these OEMs. What do you think is the trajectory on this? How long does it take to revert? Do you see this happening in a year, 2-3 years? How do you see it?
It seems positive because the demand supply, position has actually changed in the last 6 to 8 months. So just to give you a context, OEM business grew by 29% for us this year. Am I right, Anisha? It's 29%.
Yeah.
So feel pretty good about it, that markets are changing. OEMs are starting to spend more money than they did. Digital emphasis is increasing. In fact, the year before that was a tough year because really supply was not available and OEMs chose to not cut but hold advertising. But a lot of it has bounced back in the last year, which you can see in our results as well. At this stage, actually, the market is reasonably favorable. It's very similar to what it should be. There is demand. There is in couple of manufacturers, demand is much more than supply, but generally across the board, supply seems to be getting better.
Understood. And my second question related to the first one itself, right? So when OEMs are shifting to more of their ad spend digitally, a lot of the spend is, I think, happening also on video and other such formats, which I don't think Cartrade has as of now. So how are you trying to get that wallet share from OEMs?
We're a different segment, right? So you're right. I think out of the total digital spend, manufacturers spend on OTT platforms and even horizontals. We are really a verticalized business for them, which gives them the lowest cost of customer acquisition. So I think the reason Carvale is compelling to manufacturers is just because it's the lowest cost of customer acquisition from them. With all the 34 million customers coming, or most people buying a new car coming to our platform, this is the single biggest destination for accessing customers. And as I told you, as they have more and more supply and demand is lower than supply, they need these customers to increase their sales. So we are more of, as I said, verticalized business with a very focused set of customers for them. And in many cases, the lowest cost of acquisition for them for a customer. And that's where we make our own space, in this whole digital advertising space. So if they put an ad on a OTT platform, it's a very generic customer who's seeing the ad. And therefore the cost of advertising is much higher for them versus putting up ads or partnering with Carvale.
Sure. Just one clarification on this one. Do you see the vertical versus horizontal shift in the OEM advertising spend, or is it roughly will stay?
We think it'll stay this way. Both have their own purpose. Horizontal gives them a different kind of reach and brand capability. Verticalized gives them an immediate customer with the lowest cost of acquisition. So it will probably continue as it is. What we try to do as a company is try and go deeper and deeper in our offerings to manufacturers, so that we always stay relevant to the manufacturer. So, the deep integration, even now we're doing multiple integrations with multiple manufacturers so that their offering becomes stronger for the customer. And that's where we invest all our product and technology today, so that we stay relevant versus horizontals. I think that's the...
Understood. Thank you.
Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a next question from the line of Vijay Jain from Citi. Please go ahead.
Yeah, hi. Thanks for the opportunity.
Hi,
can you hear me? Vinay? Hi.
We can hear you, Vijay. Thank you.
Great. Hi. Hi, Vinay. Hi, Anisha. My first question is on the standalone business. So you share the traffic trends on a quarterly basis. Are there any other metrics of traffic engagement that you can share? In terms of, say, user-generated content like ratings, reviews uploaded every quarter, or time spent, whatever makes sense. Is that possible to do?
We can try and share it to you. I don't have it right now, but we can try and share it with you. But these are also publicly available on many competitive platforms. But we do look at things like time on site, bounce rates, page views, and things like that, which are clearly best in class, even when you look at those numbers. But we do need to look at it. I don't have it right now, but maybe we can try and share that with you in comparison what's available to us with us.
Got it. And Vinay, just related to that, is user-generated content on the website something that you think is important and relevant to the business in the way you do it? And do you track that? Because at least those things, right, whether people are uploading their own reviews and stuff, could be indication of how, copyright content for you or rather, proprietary content for you.
User-generated content is important, but it's not the primary content or the most visited content on our website. I think what tends to be is comparative shopping, comparing one car with the other car. People come for many reasons, and one of the big reasons they come to us is to understand what car to buy. And that partly comes from user content, but lots of it comes from understanding expert opinions, understanding comparative features, understanding maybe a video or 360 or a different view of the vehicle, to finding out a dealer to buy from, what price to pay, etc., etc. So even though there is a lot of user-generated content, it's not the primary reason in India why they come to us.
Got it. And my second question, Vinay, is on the remarketing business. So I believe in the last call also you mentioned, and you've said a couple of times now that, the repo market is going through a tough time. The consumer market in the remarketing business is doing well. When I look at those metrics you shared, right, it looks like, likely the repo business is kind of flattish QOQ and the retail business continues to do well. So, just based on those numbers, right, 69% of the business last year versus 55% this year, 53% previous quarter, it looks like you're now at around 29-30 crores in repo and retail is around 24-25 crores. So I'm just wondering if on an absolute basis, has repo bottomed out in your view? Because it seems to be
bottomed out. It seems to have bottomed out. Yes, if that's the question, it seems to be. I think it's quite last quarter, although it's down, it's pretty much similar for last 2 quarters, but it seems to be bottomed out. Yeah.
And in terms of margins, just on a sequential basis, obviously in this business, while absolute revenues is kind of flattish QOQ, margins have improved. Is that also a function of the mix?
Yeah. Retail by definition is a little higher margin for us. So if you can build, I think there are 2 things in retail. One is if you can build retail fragmented supplies, we call it. One is margin slightly better, but also our ability to differentiate, right, from any kind of competition might come in the future is very high, because when you have high level of fragmented supply, it's very hard for people to replicate, right? So there are 2 advantages of that. One is the immediate margin, but bigger thing is the ability to defend and create moats around our business, which will be impossible for someone to break through a little later.
Got it. And just to understand this right, the retail is essentially C2B2B for you, right? You're buying
it could be C2B2B, it could be C2B, it could be customers coming to us, it could be customers coming through a very small broker or middleman to us, either, both ways.
I see. Got it. Understood. Thanks.
But they're very fragmented, very small middleman brokers. They're not bulk. It's not highly high. Very insignificant in terms of per person volume.
Got it. Understood. Thanks.
Thank you. We have our next question from the line of Sanjay Parekh from Sohum Asset Managers. Please go ahead.
Yeah, thank you. So my question to Vinay is that today on standalone, let's say, we're doing 156 crore turnover and the core operating profit, which is excluding other income, is 23 crores. So just, in 3 years from now, for our leadership that we have, clearly which is showing up in our ratings and, viewership, the downloads. This seems to be quite low in terms of the overall pie, which is largely advertising and referrals from dealers. So 3 years from now, the question is that 3 years from now, can we grow at 25%? And if yes, then should this operating leverage kick in terms of, more like 25% margins in 3 years from now? I'm not trying to get a number. I'm just trying to get your vision for 3 years for this company on standalone first.
So is the question that 25% on top line? Is that the question?
Yeah. So the first is the top line 25% growth, because the pie looks quite small for the leadership we have. And the opportunity that I'm trying to understand. The second is, if that 25% growth were to come through, we've done 19% core operating profit margin in the fourth quarter.
That's right. So
should this be around 25% in 3 years from now?
Right. I think it's a good question. The one thing I want to highlight here is that about 13-14% of money spent by manufacturers and dealers and advertising is on digital. In most countries, it's about 40%. So one can see that manufacturing dealers' money in the next 3-4 years or 5 years going from 13-14% to maybe 20-25% or 30% digital. So that's one factor of growth for us. As I told you, the last 5 years CAGR of our entire business is about 23% and a 69% growth in EBITDA. So we definitely feel that, if we are able to grow as a number you've given at 25 or 30 or 20%, the EBITDA will go to at a higher clip and the margins should improve. As we've demonstrated, last year as well, coming to the 19%. I think the same question was asked last year. And we feel that any kind of revenue growth from here leads to increase in margins. There may be odd years where, manpower costs go up a little higher, But generally, we feel pretty confident that revenue growth increases in margins.
Yeah, thank you. That is very helpful. The second question is on the standalone. While, there's a cyclical weakness currently, but again, the same question here, our attributable EBITDA is 50%. And I think roughly, if I remove other income, we are at a 50 crore EBITDA, 45 crore EBITDA. So, we as economic interest get 50%, so that's 25 crore. So 3 years down the line, again, for the same question here, it will certainly not grow at that rate, but do you see once the cyclical part is over, this should be more like 10 to 15% top line, and then again we get an operating leverage, or what would be your right?
Yeah. I think I tend to agree that as we build our other verticals, one is we're hoping that the repossessed market, as I said, it is cyclical. So 3 to 6 months later, should come back. And second is we can build other verticals like retail, which have higher margins, also are more defensible. We should see a reasonable growth in this business. And as well as this is again a very similar business where it's a marketplace. We don't take positions on vehicles. It's an asset-light business. So as we see volumes go up or revenues go up, we clearly have a differentiated margin structure here as well. So I think it's pretty similar. They're both marketplaces. One is a C2B, B2B marketplace, and one is a B2C marketplace. But the nature of the business are quite similar.
Sure. No, very, very helpful. The last is, clearly we understand you're conservative, and that's a very good virtue as a management. So, we have 1,100 crores cash now. Yeah. So, in terms of how do you think about acquisitions, and in terms of clearly the payback period, a little bit of your understanding of what are the areas, if at all you are thinking, would help.
So the way we think about in any investment or acquisition or users' money is that it's really got to be a business which is going to help a current set of users, or it's going to be a business where our current product and technology can be used for a new set of users or consumers. But the intent here is, of course, to look at businesses which are synergistic to our current businesses. Obviously, a threshold for us to do this is high because we'd like to see that when we look at an investment acquisition, there's the management team which we are investing behind, or the business model, or the scale of that business is of a certain level. And I think we've in the past done 3 such acquisitions, all 3 being successful. In fact, Shriram Automall, Carvalho, both acquisitions, and all been successful. And therefore, you're right, the threshold is high because we want to make sure we get it right. We're not a company which is in the past, done tens and 20s or 30s of investments and acquisitions. And so we are prudent about it. We like to, have a proper thorough look at what we're doing. And if we find something of even a little bit higher size of acquisition, we are not afraid as long as we are convinced that, we can make it work.
Yeah. Thank you very much. Very helpful.
Thank you.
Thank you. We have our next question from the line of Pramod Amte from InCred Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. Couple of questions. One,
sure.
What's your recent experience in terms of availability of used cars? Has it improved? And what's the outlook for the same next year? And second, relevant to the same is what has been the inflationary price trends for used cars, and how do you expect that to behave going forward?
Yes, we've actually seen supply used cars it's actually really hard just post-COVID, but in the last 6 months we've seen supply get better and of used cars. And I think that comes from, as I said, at that point of time that as new car supply improves, people tend to sell their old car and buy new cars. It's very hard to sell your old car when the new car is not available because you tend to replace it. So as new car availability has gone up and deliveries have increased, and as new car market, as you can see, is grown by 28%, used car supply has got better. So I think that's one big trend, which is good for the used car industry. The other thing, of course, we've seen not only in used cars but also in new cars, is a trend you may be seeing as well, is that the average ticket size or customer preference or behavioral to buy has changed, which means that today if someone is buying a new car, they tend to now buy the highest variant of the same type, which is a very different behavior to which was there maybe 3, 4, 5 years ago. So the average ticket sizes for most car manufacturers itself has gone up. And as a result, you're seeing even the used car market, the average ticket size going up. So we've seen inflationary trends where the used car average ticket size of price has gone up, number one. And that's similar in the new car industry as well. So these are all good things for the car industry when you have average prices of new cars and used cars going up, because people are making new choices on model, make, variant, and supply is increasing in the used car market, or sales increasing in the new car market. So these are just basically favorable trends for the entire car industry in the last year or so.
Do you compare on a like-to-like feature, how have the used car prices going up? What's the trend there? I understand people are upgrading.
We do actually on our website look at the average listing price today versus what it was, 2 years ago or 1 year ago, 3 years ago. We have that data. And also we look at our AppSure outlets, the average selling price today. This is what might be, some time ago. So we tend to compare this just to know what's happening in the car industry. And of course, we've got relevant data available with us.
And the second question, the third one is related to the competitive intensity. Do you see that easing already, considering the funding challenges which we see in global markets and that percolating down? And as a result of which will also may get reflected to you in terms of reduced competition to procure these used cars?
So we are a marketplace, an all-inclusive marketplace. We of course, as you know, are profitable and generating cash, and some of the other players in the industry are losing money or losing cash. We actually are not. We are not a business which buys cars or takes position on vehicles, etc., etc. Many of the other players whom we are referring to as competition actually buy cars, refurbish them, and sell them. So they're almost like online dealers. Some of them are even our customers because we don't see any conflict in them putting vehicles in our marketplace to sell. So we almost, with some people who are terming as competition, they're actually now more customers to us than competition. I think let's put it this way. So for us, we've tried to keep a very inclusive marketplace where everyone can play a part. Whether you're a bank, you can sell loans. Whether you're a dealer, you can sell vehicles. You're a manufacturer, you can sell vehicles. Or if you're one of these online dealers, you can also sell vehicles on our platform.
Thank you. I request you to come back in the queue for follow-up questions. We have our next question from the line of Pratyush Agarwal from White Oak. Please go ahead.
Hello. Hi, am I audible?
Yes.
You're not very clear. Can you speak louder, please?
Is it better?
Yes.
Yeah. So I just have one sort of question. So both on Bike Wale and Car Wale, right? So we see these non-automotive advertisements as well. So I mean, do you have a? So first question is sort of like you mentioned, right? These websites are very vertical specific, and it makes a lot of sense for automotive guys to target on these websites, right? So first question is really that why are there sort of non-automotive advertisements? And second, sort of if you can provide a rough mix of auto versus non-automotive revenue from these two sets.
Sorry, I didn't get non-automotive, automotive on which website?
So both on Car Wale and Bike Wale, right? We see these, on your website, there also seems to be non-automotive advertising.
No, the non-automotive is very insignificant. I know a number, but very insignificant. I think what happens is most advertising is automotive, which are either manufacturers and agencies, etc., and dealers. Sometimes you have free space on a website. So you use a program which allows you to fill it up. It's like a fill rate. But the quantum of revenue generated is very insignificant from a non-automotive. I mean, I would think, I don't know, in terms of our total company, less than not even 1% of our revenue.
Got it. And if you could
it's just a filler because you don't keep your ad space free. So it's just, there are various programs which allow you to take ads of non-automotive. Yeah.
So it's not a function of getting less traction from the automotive guy. It's just it's more of just filling ad space. Is that correct?
It's just filling ad space. Yeah, it's not. As I said, less than 1%. It's not significant and not something we focus on.
Right. And sort of given last year both and from what we understand from the digital ad market. So sort of how has your conversations on pricing been, in the past year, and how do you see it going forward?
For us, it's been a lot about working with manufacturers and dealers pricing has been stable. It's not gone up, it's not gone down. I think for us, it's also about getting more budgets and providing more value. And I don't see us increasing or decreasing prices. I think there may be some gradual inflationary increase, but not dramatic increase in prices or decrease.
Got it. Thank you.
Thank you.
Thank you. We have our next question from the line of Rakesh Jain from Axis Capital. Please go ahead. Mr. Jain, we are unable to hear you. Your voice is breaking.
Hello.
Yes.
Hi, Rakesh. Hello.
Yeah, hi. Just one question on bookings side. The other expenses have seen jump from last 2 to 3 quarters. Right? Any particular reason or are there any one-offs being recorded?
It's just on which, Anisha, I didn't hear which, on the console level. Anisha, you want to answer that?
Sure. The last quarter was 24 crores, which has gone up to 25 crores. Is that the number you're looking at?
So 3.2 crore is the number I'm looking at.
Other expenses, Anisha.
I'm also looking at other expenses. I was looking at the other expenses. Rakesh, if you could just explain, this is quarter ended December and quarter ended March. The other expenses at consolidated level was 24 crores last quarter and has gone up to 25 crores. Is that the number you're looking at?
24.19 has become 25.34. I think that's...
Yes.
No. I'm looking at 3.2 versus 3 crore last quarter. Not sure if there's some adjustment to that.
I'm sorry, can we come back to this slide? Because I think we're looking at...
Your console level other expenses is 3.2 at March quarter and it was 3 crore last quarter.
No. I think you're looking at the wrong slide or...
No, I'm looking at the press release, the quarterly press release.
So let me just quickly have a look at that, please. And I'll come back to you. Give me a minute.
Sure. And just one more thing. You mentioned that there's a one-off, only one-off totals you were mentioning, the ESOP expense of 27 crore. Right? Is that correct?
In this quarter was about 7.3 crores. For the year was about 27.9 crores.
Okay. Thanks. Got it. Thanks so much.
Thank you. We have our next question from the line of Sagar Sanghvi from ADD Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have 2 set of questions. In the prior calls, you have been talking of there will be a couple of new revenue drivers or segments that would also kick in revenues for some period of time. That is, you're talking of insurance revenue, insurance commission revenue, or loan disbursement fees, or maybe transaction-based revenue with car dealer. So when do you expect such revenues to kick in? And what would be the margins for this kind of segment? That is one.
What we've said. Yeah, wait. Should I just answer this? Is that okay?
Yeah, please.
So what we've discussed and what we've said earlier is mostly today people like all of us come to Carvale to find a car, select a car, find out which dealer to buy, what price to pay, compare cars, etc. And we monetize manufacturers and dealers for advertising revenues. I think what we said in the future is we're building technology and products for our platform as well as manufacturers for getting to a more purchase online methodology, which basically means can you get a loan approved online instantly? Can you book your car online? And that's where the whole Carvale app short signature movement came around. So the intent is to get closer to the transaction where you can book online, book a loan online, or maybe even buy an insurance policy, online, etc. This is not a place where there's not a thing which you can do at one point of time. This is a journey. It may take 2, 3, 4 years, and that's where we are investing all our future product and tech in. So I think our point was that as we go on, today you can find a car on Carvale or select a car on Carvale. Tomorrow you'll be able to buy a loan on Carvale. Day after tomorrow you'll be able to sell your old car instantly at Carvale. And the day after that maybe buy an insurance policy or get the car delivered. So this is all work in progress. Over the next, I would say, 2, 3, 4, 5 years, this is really where we'll have an additional sources of monetization. A lot of the loans are already online. If you come to Carvale today, you can get instant approval for a new car or used car already, right? So the various elements of it being built as we go on. It's not significant today, the revenue. It'll take some time for it to become significant, maybe 2, 3 years. While our digital advertising revenue continues to grow, this will become additional sources in the future.
Okay. So let's assume you would be having, let's say, 100 rupees of incremental revenues from all the sources on the standalone business. So, and you're given your most of the cost is fixed, linked to inflation. So what kind of incremental EBITDA margins that we should be looking at over next 2, 3, 5 years?
The incremental EBITDA, as we discussed earlier, would mostly come from our advertising revenue growth because of leverage we have, right? The cost against this would be mostly product development costs and technology costs because the customer acquisition is really the same. It's hard to say at this point to give a guidance around what incremental margins or EBITDA margins will come from this. But clearly it's an investment we are making already. If you see our financials, these investments are already being made. In fact, they're an operating cost, these technology and product investments, and we continue to do that and invest in it. So we do see margin increasing as these revenues kick in. I can't exactly quantify the amount of margin increase, but yeah, there is very little cost against some of these future revenue streams.
We'll go on to the next question from.
Before we take the question, I would just want to go back to Rakesh's question. I even went through the press release. These numbers are not really there, Rakesh. Could you please help me and understand what numbers are you referring to?
Do you want me to unmute him?
Yes, please.
Just a moment, please. Mr. Jain?
Yeah.
Yes.
Yeah, so maybe I'll get back to you with, maybe we can connect after.
No problem at all.
Yeah.
Thank you.
Thank you. We have a question from the line of Shirish Vaze from Money Life Advisory Services. Please go ahead.
Yeah. Thank you, sir, for taking my question. My question pertains to, we had announced setting up of Cartrade Ventures. So I just wanted to understand our thinking behind this and the kind of corporate structure that we are looking for this. So would this be like an in-house VC fund, or what exactly would be the structure for this? Thank you.
Yeah, thank you. See, one of the things we've always talked about is that we would like to invest or acquire companies in our automotive ecosystem. We have 35 or 34 million customers a month coming, and today they can come and find a new car or a used car. Tomorrow, we like them to avail of a loan or an insurance policy or service their vehicle or sell their old car or other things in the automotive ecosystem, right from automotive software, etc., etc. So what we've done is really formed a team which is really looking at augmenting our current products and services with investments and acquisitions. And I think the brand Cartrade Ventures was formed for that. And the intent is to use over a period of time our generated earnings, our cash earnings every year, and some of course our retained earnings, and look at whether we can add additional products and services to these set of customers, or if we can buy technology which our current customers can use. And I think the intent here is that can we incrementally grow faster inorganically, apart from the growth rates you're seeing organically in our business. I think the one good thing we feel about our business is, compared to all the other automotive internet companies and others in the internet space itself, both our businesses are cash profitable and generate cash, and are pretty stable over a 5-year period. So we feel good that, can we add more products and services to these sets of users, or can we bring new products and services to our users? Or buy new technologies as well. So, the intent of Cartrade Ventures is that, as I said, we will keep looking at transactions and investments in the automotive ecosystem and see if something comes around.
Got it. Thanks, sir. That was my question. I'll get back in the queue.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Vinay Sanghi for closing comments. Over to you, sir.
Thank you. I just want to thank all of you for joining this call. It's been a eventful year for us. One of our businesses, the consumer group, has done well, and the other one has faced headwinds. But overall, we've had this highest ever revenue and highest ever profitability, EBITDA as well as PBT. Again, thank all of you and look forward to interacting with you in the future. Thank you, everybody. Thank you.
Thank you.
On behalf of Cartrade Tech Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.